Welcome back to the Deep Dive. It is Thursday, February 26, 2026. And if you have been trying to make sense of the headlines this week, you might be feeling a little bit like a GPS that has just totally lost its signal.
Oh, yeah.
You know that spinning icon? Recalculating.
Yeah.
Recalculate. That is exactly what the entire global economy feels like right now.
It has been a week of mixed signals, hasn't it? I mean, I don't think mixed even does it justice, honestly. It's more like we are getting green lights and red lights at the exact same intersection at the exact same time.
That is putting it mildly. I mean, just look at the board right now. We have Asian markets hitting record highs. The Nikkei is literally through the roof, smashing past 58,000.
Right.
But then, while that's happening, tech stocks here in the U.S. are having a bit of a meltdown.
Yeah, a significant one.
And then in Washington, we have the Supreme Court battling the White House on trade policy. We have massive layoffs at companies like Block and C3 AI happening at the exact same time that we are seeing breakthrough innovations in those exact same sectors. It is whiplash city.
It is. It's a moment of calibration.
Yeah.
That is the word I keep coming back to this week as I was looking through all the source materials. Calibration.
I like that word.
Because the markets, the courts, and even, regular consumers just standing in the aisle at the grocery store, everyone is trying to find a new equilibrium. We are seeing high tech meet hard limits, whether those are limits of physics or profitability or legal boundaries. It is just a massive reality check across the board.
Exactly. And that is our mission for this deep dive. We're going to try to ignore the noise, and there's a lot of noise out there to figure out where the actual signal is.
And we have a lot to get through.
We have a massive stack of sources today. We've got the forensic analysis of NVIDIA's earnings, and let me tell you, the devil is really in the details on that one. We have legal briefs from the Supreme Court on tariffs that just shifted the entire global trade landscape.
Plus fresh data on food prices.
Right, which might actually contradict what you just heard in the State of the Union. And we also have some really interesting trends on where the world's billionaires are moving their money right now.
And our goal today is to cut through that noise, because there are some really headline-grabbing numbers out there, like a 10% global tariff or a $5 billion insurance dividend. But we need to understand the structural shifts underneath those big, flashy numbers.
Right. What does this actually mean for the global economy? And maybe more importantly, what does it mean for your wallet?
Exactly.
So let's just unpack this. And there is really only one place to start. The elephant in the room.
Mm-hmm.
Or maybe the distinct lack of an elephant. I am talking about NVIDIA.
The NVIDIA earnings, yeah. This was the event literally everyone on Wall Street was waiting for. It has basically become the Super Bowl for the financial markets.
It really has. So let's look at the raw numbers first, because on paper, if you just glance at it, this looks like an absolute blowout.
It does.
NVIDIA reported what looked like a stellar quarter. Revenue is up 73% year over year to over $68 billion. They beat analyst expectations on the top line. They beat on the bottom line. By any traditional metric, this is a home run.
Right. By traditional metrics, yes. But the thing you have to remember is NVIDIA isn't trading on traditional metrics anymore. It is trading on perfection.
Right.
And when you are priced for absolute perfection, excellence just isn't enough. The market had built in such astronomical expectations. You have these so-called whisper numbers that traders share on Signal and Telegram, and those were even higher than the official analyst estimates.
So even though they beat the official numbers, they missed the whisper number.
Exactly. So even a beat felt like a letdown, which is why the stock sank 5%. But there's something much more specific happening here than just a general feeling of disappointment.
You were talking about the 10K filing.
Precisely. If you dig into the 10K regulatory filing, there was some language in there that absolutely spooked investors.
Break that down for us.
Right.
Because nobody reads the 10K except the algos and the really nervous analysts.
Well, there has been talk for months of this massive $100 billion investment or partnership structure involving OpenAI. The market was essentially banking on that capital expenditure to keep the NVIDIA revenue train moving at top speed.
Right. $100 billion buys a lot of chips.
It does, but the filing explicitly said there is no assurance that the deal will be completed.
Wow. No assurance.
Yeah.
That is basically lawyer speak for do not count your chickens before they hatch.
It is. It's a massive red flag for anyone projecting future revenue based on that deal. And it feeds into this much broader anxiety that's bubbling up. We are seeing a fundamental shift in the computing landscape right now.
Oh, so?
Well, for the last few years, the massive, insatiable demand for NVIDIA's chips has been driven by what we call training, building the actual brains of these AI models.
Right, the brute force part of it?
Exactly. That requires immense raw computing power. You need tens of thousands of GPUs running at 100% capacity for months on end just to train a model like GPT-6 or Gemini Ultra.
But now, the market is looking for the transition to inference.
Yes, inference. Training is teaching the model. Inference is applying it. Inference is when you or I actually use the AI. Like when I ask a chatbot a question on my phone and it gives me an answer. That is inference.
Got it.
The fear on Wall Street right now is that inference might not require the same exponential growth and hardware spending that training did.
So the worry is kind of like, we have built the gym, and now we just need to go work out.
That is a great analogy. Yeah. We built the mega gym. We bought all the heavy equipment. If the heavy lifting of building that infrastructure is slowing down, or if the daily workout, the inference, can be done on cheaper, less powerful chips, then the demand curve for NVIDIA changes drastically.
So you have this specific uncertainty about the OpenAI deal combined with this huge structural question about future demand.
Right. Investors are looking around asking, okay, we bought all the shovels, now where is the gold?
And speaking of digging for gold, NVIDIA's CEO Jensen Huang had to play a bit of defense this week, didn't he? He was on a huge media blitz.
He was everywhere because there has been this prevailing narrative, and you can really see it with the software stocks taking a beating lately, that AI is going to just eat software.
The cannibalization fear.
Exactly. The idea is that if you have a perfect AI agent, you don't need to pay for Salesforce or SAP anymore. You don't need all these dashboards. You just tell the AI what to do, and the AI goes and does it in the background.
Right. Why pay for 1,000-seat licenses for a really complex piece of software if the AI can just write the code or execute the function for you?
But Huang is pushing back extremely hard on this idea.
He is. He went on air and explicitly said, quote, "The market's got it wrong," which is a bold thing for a CEO to say about his own ecosystem.
It is bold. But his argument is fascinating. He views these AI agents not as replacements for software, but as tool users.
Explain that analogy for us, tool users. What does he mean by that?
Think of it this way. If you hire a super intelligent, incredibly fast human assistant, you don't suddenly fire your accountant and throw away all your spreadsheets.
No, you give them the spreadsheet.
Right. You expect that assistant to use Excel and your accounting software better and faster than you ever could. Huang is saying these AI agents will be power users of platforms like ServiceNow and SAP.
So instead of a human employee logging in maybe 5 times a day to update a record, the AI agent logs in 50,000 times a day to optimize every single microtransaction.
Exactly. So his argument is that AI will make those platforms more essential, not obsolete, because they will be processing way more volume through them. It is an argument that suggests software companies are the actual infrastructure that AI rides on.
Okay, that is a very optimistic spin. And it certainly serves NVIDIA's interest to keep the software ecosystem healthy in buying chips. But not everyone is buying that narrative, are they?
Not at all.
Because I saw Dan Niles, the portfolio manager, out there warning that some software companies are literally going to, quote, go to zero.
Yeah, it is a very polarized view right now. On one side, you have Niles predicting extinction events. He truly thinks AI is a massive deflationary force for legacy tech. It's going to wipe them out.
And on the other side?
On the other side, you have folks like Jim Cramer using a rugby analogy. He was calling it a scrum.
A scrum. Violent, messy, everyone just pushing against everyone else in the mud.
Right. Cramer thinks that the big software giants are going to survive. They will merge, they'll adapt, they'll buy up the AI startups. But it is going to be messy and violent for a while. It is no longer a straight lineup for tech stocks.
Messy really seems to be the key word here. And that messiness is bleeding into the broader market sentiment in a way that I found really surprising. We saw a new survey from Bank of America this week that just totally caught my eye.
The Credit Investor Survey.
Yes. They asked credit investors what their #1 risk was. And for the very first time, AI bubble took the top spot.
That is a massive shift in market psychology. For a long time, the top risks in those surveys were always inflation or geopolitics.
Always.
But now, 23% of the respondents are saying the AI bubble is the single biggest threat to the market. It actually overtook geopolitical fears, even with everything currently happening in the Middle East.
That is just wild to me. We have actual hot wars happening. We have massive trade wars starting up. And yet, the money men are most afraid of a tech valuation collapse.
Because the concentration risk is so insanely high right now. The S&P 500 is so heavily weighted toward these few massive tech giants that if the AI bubble pops, it doesn't just hurt tech, it takes the entire market down with it.
Right. Everybody's 401k takes a hit.
Exactly. And it isn't just an abstract fear of valuations. We are seeing real operational pain in the tech sector right now. I mean, we talk about the AI boom constantly, but look at the layoffs just this week.
Yeah, let's talk about C3 AI. This is a company literally named after the trend. Their ticker symbol is AI.
You can't get more on the nose than that.
And they cut 26% of their workforce this week. Over a quarter of the company, gone.
That was a very harsh reality check for the industry. Their CEO, Stephen Akin, was very blunt about it. He said their cost structure was, quote, simply too high.
Wow.
It is a stark sign that even in the absolute hottest sector of the economy, operational reality still matters. You can't just ride the hype wave forever. Eventually, you have to actually make money.
Right, you can't pay mediocre engineers $500,000 a year if the revenue isn't matching that insane burn rate.
You just can't. And it wasn't just them. Block, the company formerly known as Square, Jack Dorsey's company, they laid off nearly half their workforce, over 4,000 people.
Half the company.
Yeah, and eBay cut 6%, which is about 800 roles.
Now, the eBay move is particularly interesting to me because it really highlights the juxtaposition we mentioned in the intro. They are cutting 800 jobs, right?
Mm.
But in the exact same breath, in the same news cycle, they announced they are acquiring Depop and investing heavily in their own internal AI tools.
That is the ultimate capital reallocation euphemism.
It is ruthless. They are literally firing humans to fund the AI, or at least they're cutting their legacy costs to fund the new tech.
It's brutal for the employees involved, obviously.
Yeah.
But from a pure corporate strategy perspective, it is a very clear, very loud signal of where these boards think the future value actually is. They are stripping these companies down to the studs so they can rebuild them for this new era.
It is calibration in the most ruthless sense of the word. But before we get too gloomy about the job market, I do want to mention one lighter moment from the tech world this week. Or maybe it's a serious moment with a really silly name.
Oh, I know where you're going with this.
Google launched their update to that viral image generator.
Ah, yes. The internal code name that somehow leaked to the public and they just rolled with it. Nano Banana 2.
I still cannot get over the name.
Yeah.
Nano Banana 2. It sounds like a bad smoothie you'd buy at a mall in the 90s, but apparently the tech behind it is actually serious.
It is very serious. Jokes about the name aside, the technical specifications on this release are a massive upgrade. It has much better what they call world knowledge.
What does that mean, practically?
It means it actually understands physics and lighting and spatial relationships in a way the previous models just didn't, and it follows complex instructions much more precisely.
So if I ask it for, say, a cat riding a unicycle while juggling chainsaws, it actually gets the chainsaws right this time.
Exactly. It won't merge the chainsaw with the cat's paw. And it handles text generation within images much better, which has been a huge struggle for all these image generators up to this point.
Right, they usually spit out alien hieroglyphics.
Exactly. So it is a good reminder that while the business side of AI is going through this painful correction and a reality check, the technology itself is still accelerating at breakneck speed.
The tools are getting better?
The tools are getting better even if the stock prices are getting wobblier. The engineering does not slow down just because the CFO is nervous about the burn rate.
That is a great point. Okay, so that is the high-tech meets hard limits part of our equation today. Now let's pivot and talk about global trade meeting hard boundaries. Because while the markets were freaking out about NVIDIA chips, Washington was completely freaking out about tariffs.
This was a historic week for trade policy, truly. We had a direct clash between the Supreme Court and the executive branch. It was essentially a constitutional crisis disguised as a trade dispute.
So let's set the stage for you listening. Thursday, February 26th. What exactly did the Supreme Court do?
They struck down a very significant portion of the tariffs that President Trump had implemented recently, specifically the ones utilizing the International Emergency Economic Powers Act, or IEPA.
Now, explain IEPA for a second, because I thought this was usually reserved for, like, freezing the assets of foreign terrorists or dealing with rogue nations, right?
Historically, yes, that is exactly what it's for. It gives the president sweeping unilateral powers to regulate commerce during an, unquote, unusual and extraordinary threat to national security. The administration's argument was that the massive trade deficit and the decline of domestic manufacturing were, in themselves, that extraordinary threat.
And the Supreme Court said what?
The Supreme Court said no. They essentially ruled that you cannot use emergency national security powers to arbitrarily rewrite permanent economic policy. It was a massive structural check on executive authority.
That sounds like a devastating blow to the president's trade agenda. But then came the pivot, and this is where the politics and the markets get really interesting.
The pivot was immediate. The administration didn't even blink. They pivoted to Section 122 of the 1974 Trade Act.
Which is what?
It is a totally different statute.
Okay.
It deals specifically with balance of payments deficits, and crucially, it allows for temporary surcharges to fix a deficit.
And here is where the calibration we keep talking about comes in. Trump had threatened a massive 15% global tariff in response to the initial ruling. But when the new Section 122 order actually came down, it was a 10% tariff, and it was strictly limited to 150 days.
And the markets absolutely loved it.
They really did. I mean, look at the Asian markets. The Nikkei hit a record 58,583. The European stocks 600 was up almost a full percent. But why? Because a 10% tariff is still a huge tax on global trade.
It is. But the market was pricing in 15%, a
Yes.
permanent 15%. When they got 10% for a limited window of 150 days, it sparked a massive relief rally.
It's the classic less bad than expected scenario.
Exactly. The market hates uncertainty more than anything else. A 15% permanent tariff is structurally bad for global earnings. A 10% tariff that expires in 5 months, that feels manageable.
It feels like a negotiation tactic.
Yes. It feels like leverage for a trade deal, not the start of a permanent global trade war. It essentially removed the absolute worst-case scenario from the table, at least for now.
It's amazing how a 10% tax on literally everything imported, which is going to be a huge cost to somebody, can be seen as good news on Wall Street just because it wasn't 15.
Right. But it seems like this legal battle has finally woken up Congress, too. It really has. For a very long time, Congress has essentially just delegated trade authority to the president. They handed over the keys decades ago and said, you drive.
Yeah.
But this Supreme Court ruling has clearly emboldened them to try and reclaim that constitutional power. You had the House voting just this week to overturn the tariffs specifically on Canada, and crucially, 6 Republicans joined the Democrats to do it.
And we had that amazing quote from Representative Don Bacon, a Republican from Nebraska. He explicitly said he is, quote, freaked out.
Freaked out is a very honest, very raw assessment for a sitting politician. And honestly, he should be. Nebraska is deep agriculture country.
Right. Corn and beef.
Exactly. When you start a global trade war, the very first thing other countries do to retaliate is stop buying American corn, American soy, and American beef. His constituents are literally the tip of the spear in any trade retaliation.
So you see this friction growing really fast. It isn't just a simple Democrats versus Republicans narrative anymore. It is Congress versus the executive branch, and it is cutting straight across party lines.
It really is. And it's not just isolated to tariffs either. There is a war powers resolution regarding Iran coming up for a vote next week, and it's being led by Ro Khanna and Thomas Massie.
Now, that is quite the bipartisan duo.
Yeah.
You have a very progressive Democrat from Silicon Valley and a staunch libertarian Republican from Kentucky teaming up.
It is the horseshoe theory in action. When those two are teaming up on a bill, you know the political establishment is in trouble.
Yeah.
It shows a rapidly rising tide of anti-executive sentiment in the Capitol. Whether it is war powers or trade powers, Congress is actively trying to claw back the keys to the car.
And we are seeing very similar friction in the tech space regarding China policy.
Yeah.
There is legislation advancing right now to block advanced chip sales to China, led by Representative Brian Mast. And this got surprisingly personal.
It did.
Mast actually accused Jensen Huang, bringing it all the way back to NVIDIA, of wanting the U.S. to, quote, trust the CCP.
That is a very heavy, very loaded accusation. It fundamentally questions the loyalty of one of America's most important, most strategic CEOs.
What is NVIDIA's defense here? Because, let's be honest, on the surface, fighting for the right to sell your most advanced high-tech chips to a geopolitical rival does look pretty bad to the average voter.
It does look bad on a bumper sticker, but their argument is subtle, and it's important. They say, look, if we don't sell them the chips, someone else will.
Right.
Maybe not today, but eventually. Or worse, China will just invest massively and develop them domestically.
Which they are already trying to do.
Exactly. So NVIDIA's argument is that by cutting them off, you aren't actually stopping their military long term. They will get chips elsewhere or build their own. What you are doing is hurting American industry leadership today. You are taking away the billions in revenue that NVIDIA uses to fund the R&D that keeps America ahead of everyone else in the first place.
So the argument is basically, let us take their money so we can use it to build better tech than them.
Precisely. It is the commercial dominance argument versus the security blockade argument. And right now in Washington, the blockade argument is definitely winning the political battle.
It seems like every single aspect of the economy right now is becoming a battlefield for these much bigger geopolitical and constitutional fights.
It's all connected.
But I want to bring it down to the ground level for a minute, the kitchen table. Because while Supreme Court rulings on the Trade Act of 1974 are important, most people are just looking at their grocery bill.
Absolutely. The kitchen table economy is where the rubber actually meets the road for 99% of the country. And this brings us to the State of the Union address.
Right. President Trump made a very specific claim during the speech. He stated that prices for beef, chicken, and eggs are falling. He basically took a massive victory lap on food inflation being over. But we have the source data here. Does that claim actually hold up?
It's a mixed bag, to be completely honest, a very mixed bag. Let's start with the eggs, because that's the good news. On eggs, he is completely correct. Prices are down significantly. They are down about 60% from their peak.
Okay, so omelets are definitely cheaper.
Yeah.
But why? I mean, did the administration pass a new egg law?
No. It is mostly biology, not policy. The prices spiked massively a year or two ago because of the avian bird flu wiping out millions of laying hens across the country.
Right, the supply just vanished.
Exactly. Now that the flocks are finally recovering and repopulating, the supply is back up and prices are crashing back down to normal historical levels.
Okay, so biology solved the egg problem. But what about the center of the dinner plate? Beef and chicken.
That is where the political claim completely falls apart. Beef prices are actually near record highs right now. Ground beef, just regular ground beef, is at an all-time high of about $6.75 a pound on average.
That is wild. Why is beef so expensive? If general inflation is supposedly cooling off across the economy, why is my burger getting more expensive every time I go to the store?
Again, it comes down to biology and long-term agricultural cycles. The U.S. cattle herd right now is the smallest it has been since 1951.
Wait, since 1951? That is incredible.
Yeah.
The U.S. population in 1951 was less than half of what it is now?
Exactly. We have fewer cows per person in this country than we have had in nearly a century. And it is primarily due to years of severe drought in cattle country. Ranchers literally had to sell off their herds. They had to liquidate them early because they simply couldn't afford the feed or the water to keep them alive.
And you can't just flip a switch in a factory and get more cows tomorrow.
You cannot. A cow has a very long biological cycle. It takes about 3 years to breed, raise, and bring a mature cow to market.
Wow.
So even if every single rancher in America decided today, this afternoon, to expand their herd, we wouldn't see that extra meat hit the grocery store shelves for 3 full years. So even if the president desperately wants lower beef prices for political reasons, the biology dictates that we are stuck with high prices for quite a while.
And what about chicken?
Chicken is up slightly, about 1% year over year. So it isn't skyrocketing like beef, but it is certainly not falling as claimed in the speech. It's a really good reminder that when you hear politicians talk broadly about inflation, you always have to check the specific basket of goods they're referencing.
And so check your receipts, folks, because politicians absolutely love to cherry pick the data that makes them look best.
Always.
Now, speaking of political proposals that directly impact our wallets, there was a lot of buzz this week around these new financial proposals aimed at regular Americans. Let's start with the big one, the Trump accounts.
Right. This is the proposal for, quote, tax-free investment accounts for every American child. And they would be seeded with a $1,000 deposit from the government at birth.
Tax-free was the exact phrase used in the pitch. Is that actually accurate based on the text of the proposal?
Not exactly. And this is an area where the details really matter. Financial experts who have reviewed the proposal clarify that these look much more like tax-deferred accounts, very similar to a traditional IRA.
Okay, break that down.
So the government puts in the initial $1,000. That money is pre-tax. But when the child, who is eventually an adult, withdraws that money at age 18 or maybe 65, depending on the final rules, it gets taxed as regular income at whatever their rate is then.
Ah. So the government is essentially planting a seed for you, but they fully plan to come back and harvest a bunch of the fruit later.
Exactly. It is not like a Roth IRA where it grows tax-free and then comes out completely tax-free. And here is the real kicker that people are missing. The additional contributions from the parents, those are post-tax dollars.
Meaning?
Meaning you have already paid your normal income tax on that money from your paycheck before you even put it into the kid's account.
Got it. Now, Trump claimed in the pitch that these accounts could grow to over $100,000 by the time the child reaches age 18. I was running some numbers on a napkin before the show. Is that math even remotely realistic?
It is extremely optimistic. To hit $100,000 by age 18, starting with just that initial $1,000 government seed, you would need an annual return of about 28% every single year for 18 years.
Which is insane. The S&P 500 averages, what, about 10% historically?
Exactly. So unless you are taking your toddler's $1,000 and aggressively day trading options or investing in the absolute next NVIDIA before anyone else knows it's NVIDIA, that pure growth is mathematically not happening.
So the only way to hit that $100,000 figure is if the parents are putting in a ton of their own money.
Yes. The only way to hit that number is with massive, sustained contributions from the family. We are talking about consistent inputs of at least $150 to $200 a month every single month for 18 years straight, plus getting solid, high market returns.
It's technically possible, but it's not government magic.
Right. And it requires the parents to already have the disposable income to consistently contribute that much, which kind of brings us right back to the structural inequality issue. The families who easily have an extra $200 a month lying around are likely already saving for their kids in a 529 plan or something similar.
But there was another proposal in this package aimed specifically at workers, right? Especially those without a 401k.
The retirement match proposal.
Yes.
This one is actually modeled after the Federal Thrift Savings Plan, or the TSP, that government employees use.
Okay.
The idea here is a direct government match of up to $1,000 a year for workers who do not have access to an employer-sponsored retirement plan.
Which is actually a huge chunk of the population.
It is massive. We're talking about 56 million Americans. People in the gig economy, independent contractors, employees at really small businesses that can't afford to run a 401k program.
Right.
This is actually a fascinating shift in economic philosophy. It is the federal government stepping in to essentially act as the employer for the sake of providing retirement benefit.
It really suggests a huge move toward what you could call government-seeded individual capitalism.
But think about the macro structural implication here. If this actually passes, the U.S. government immediately becomes a massive direct investor in the stock market on behalf of tens of millions of everyday citizens.
Precisely. It actively aligns the national interest with equity market performance in a very direct, very tangible way.
If the government is directly matching your stock market contributions with tax dollars, the government suddenly has a very vested interest in making sure the S&P 500 keeps going up.
It absolutely creates a too-big-to-fail dynamic for the entire stock market.
Yeah.
The immense political pressure on the Federal Reserve and the Treasury to just keep the line going up would be unprecedented, because it's essentially state-sponsored capitalism deployed on a retail level. That is a wild concept to wrap your head around. But before we move entirely off personal finance, we definitely should mention the Navient settlement that hit the wires. Just as a quick public service announcement for anyone listening who might have student loans.
Yes. If you were a student loan borrower who was steered into forbearance by Navient before 2017, you really need to check your mail right now. Restitution checks are actively going out.
What exactly did Navient do wrong here? Remind us.
They were accused by regulators of aggressively pushing struggling borrowers into forbearance, which is a status where your payments pause, but the interest just keeps piling up and compounding instead of guiding them into income-driven repayment plans.
And IDR plans are much better for the borrower.
Vastly better. Sometimes your payment can drop to zero, and in some cases, the government subsidizes the unpaid interest so your balance doesn't explode. But it was just easier and faster for Navient's call center reps to hit the forbearance button and get the person off the phone than to sit there and do the complex paperwork required for an IDR plan.
So they essentially took the lazy, profitable route that ended up costing millions of borrowers thousands of extra dollars in compounded interest.
Exactly. It was a massive steering scheme. So if that happened to you, if your balance blew up while you were in forbearance, you are legally owed money from the settlement. It is a long time coming for a lot of stressed out people.
Good to know. Okay, so that is the situation for regular folks trying to scrape by. But what about the ultra-wealthy? Because we got some truly fascinating data this week on what they call the Great Wealth Transfer.
The raw numbers on this are just staggering to look at. Cerulli Associates, the research firm, is predicting that $105 trillion will pass to heirs by the year 2048.
$105 trillion.
Yeah.
It is almost impossible for the human brain to visualize that much money moving around.
It is. But the really interesting angle in this new report isn't just the sheer amount of money, it is the changing gender dynamic of who is going to control it.
The female factor.
Yes. Women currently control about $18 trillion in personal assets. That number is expected to nearly double, hitting $34 trillion by the year 2030. And the data shows very clearly that women invest very, very differently than men do.
How so? Because the old Wall Street stereotype was always that women were just conservative investors. They didn't like risk.
Right, but the new data suggests that the better, more accurate term is risk-aware, and there's a huge difference in performance there.
Explain the difference.
Men, historically and statistically, tend to overtrade. We chase the hot new stock, we try to time the market, we jump in and out of trends, and we constantly churn our portfolios.
Trying to beat the market every single day.
Exactly. But that constant churning racks up massive fees, it generates huge tax bills, and often leads to the classic mistake of buying high on hype and selling low in a panic. Analysts jokingly call it the testosterone tax.
The testosterone tax. I love that. So less gambling, more actual investing.
Exactly. Women, on average, tend to trade much less frequently. They set a plan, they buy, and they hold. They stick to the long-term strategy. And because of that lower turnover and lack of panic selling, they very often end up with significantly better risk-adjusted returns over the long haul.
So logically, as women begin to control significantly more of this incoming $105 trillion, that fundamental shift in investing style could actually serve to stabilize the broader markets.
That is the big macroeconomic hope. If you have vastly more capital resting in strong hands that simply do not panic sell every time there's a scary headline, the entire market inherently becomes less volatile.
That makes a lot of sense. Now, speaking of big money, we also got a peek into the portfolio's the billionaire class this week, thanks to those end of 2025 regulatory filings. Who is betting on what right now?
It is a fascinating study in contrast. When you look at the filings, you see a wild mix of aggressive offense and extremely paranoid defense.
Let's start with the offense.
On the offensive side, you have David Tepper of Appaloosa Management. He just absolutely backed up the truck and tripled his stake in Micron.
So he is making a massive bet on the specific chips needed for AI.
Specifically, the memory chips. People forget this, but AI inference and training requires massive, massive amounts of high bandwidth memory. Tepper is betting that even if the software valuation bubble pops, we are still going to fundamentally need the physical hardware infrastructure.
Right, the picks and shovels. Who else is playing offense?
Then you have Leon Cooperman at Omega. He made two really interesting moves. He bought heavily into Manchester United.
The soccer team. Is that just a billionaire vanity play? Buy a sports team because you can.
Maybe a little bit of vanity, sure. But it is also a huge content play. Live sports is rapidly becoming the absolute last bastion of must-watch appointment television. It's incredibly valuable to streamers. And his other big purchase was Rocket Companies, which is a massive bet on mortgages and the housing market rebounding.
Okay, so that is the offensive side of the billionaire class. What about the defense? You mentioned paranoid defense.
Ray Dalio.
Oh, boy.
His firm, Marino Management, reported a portfolio structure that is nearly 90% allocated in the SPDR Gold Trust.
Wait, 90% of the portfolio in gold? That's apocalyptic.
It really is. That isn't just a simple hedge against inflation. That is building a financial bunker. It is a massive, concentrated bet against currency devaluation and global systemic instability.
Wow.
So while Tepper is aggressively betting on the high-tech future, Dalio is aggressively hedging against the potential collapse of fiat money. It is a very striking contrast. You literally have two of the smartest, most successful minds in finance looking at the exact same global landscape and placing completely diametrically opposite bets.
It really is incredible to see that divergence at the very top. And amidst all this billionaire maneuvering and macro stress, there actually was one very clear piece of good news for the average consumer this week. And it came from a really unlikely source. State Farm.
Right. They announced a historic $5 billion dividend.
They're actually sending cash money back to their auto insurance customers. I didn't even know they did that.
They are. Now, the average refund per policy is only about $100, so it isn't life-changing money for any individual family. But the why behind the dividend is what is so incredibly interesting for the broader economy.
Why are they doing it?
They say accident frequency is down across the board, which is obviously good.
Are people just driving better? Or maybe the advanced safety features on new cars are finally working?
Maybe a mix of both, or people are just driving slightly less post-pandemic. But the really big economic signal they noted is that repair cost inflation is finally, definitively cooling off.
That has been such a huge driver of the overall inflation numbers we've seen over the last few years. Car repairs.
Huge.
Because replacement parts were incredibly expensive due to supply chain snarls, and specialized labor at the body shops was very expensive and hard to find.
Exactly. So to see a major nationwide insurer look at their data and say, costs are cooling down enough that we are comfortable leaving $5 billion back to our customers, that is a genuine, undeniable deflationary signal.
It really is.
It strongly suggests that the global supply chains for auto parts are finally fully healed from the pandemic disruptions.
Well, I will take it. I will take the $100, and I will definitely take the broader deflationary signal. All right, let's pivot to our final section for today, health and pharma. Because there was a ton of corporate drama in the weight loss world this week.
The battle for the obesity drug market is intensifying rapidly. It has essentially become a massive duopoly between Novo Nordisk and Eli Lilly. And Novo definitely took a painful stumble this week.
Novo Nordisk. This is the maker of Ozempic and Wegovy, right? The drugs that started this whole craze.
Right, and they have been developing a next-generation drug called cagrilintide. They were heavily pitching it to investors as the ultimate Zepbound killer.
Zepbound being Eli Lilly's incredibly popular competing drug.
Exactly, but the head-to-head clinical trial results finally came out this week, and cagrilintide completely failed to beat Zepbound's weight loss statistics.
Let's look at the actual data. The numbers were 23% weight loss for Novo's new drug, versus 25% for Lilly's established drug.
Correct.
Honestly, a 2% difference doesn't sound like a massive deal to a layperson. Why the freak out?
In the highly competitive pharma world, a 2% efficacy miss is everything. Why would any doctor switch their patient to the brand new guy with unknown long-term effects if the established market leader literally works better?
Oh, I see.
Novo's stock absolutely plummeted on the news because analysts are suddenly asking a very scary question. Have they hit a biological innovation ceiling?
And Novo's CEO is out there aggressively insisting the drug is not obsolete.
Yeah, he has to. He says they're banking on upcoming higher dose trials to close that gap. But it clearly shows that even in an absolutely booming multi-billion-dollar market like weight loss, you cannot rest on your laurels for a second. The competition from Eli Lilly is just too fierce.
And speaking of fierce competition, there was a much darker side to the prescription drug market making news right now. Novartis and Genentech filed a massive lawsuit this week that frankly sounds like something out of a medical crime thriller.
It does. This lawsuit involves what the industry calls alternative funding programs. And they are specifically targeting a company called Sharks and an unnamed Canadian pharmacy.
What exactly is the allegation here?
The core allegation is that these companies are illegally and somewhat covertly importing a highly specific drug called Xolair across the border from Canada to bypass the extremely high U.S. retail costs.
Now, importing drugs from Canada happens all the time, doesn't it? I mean, Regular people do it on buses to save money because U.S. pharma prices are just completely insane.
They do, and normally the pharmaceutical companies turn a blind eye to the retail consumer doing it. But Xolair is very different. Xolair is a biologic used for severe asthma.
Biologic meaning what exactly?
Meaning it is not just a simple, stable chemical pill you can throw in a bottle. It is a very complex, delicate protein structure. And because of that, it requires extremely strict temperature controls during transport and storage, what the industry calls the cold chain. If a biologic gets a little too hot or even slightly too cold during shipping, the proteins degrade and the medicine is ruined.
So the lawsuit alleges that these bulk unapproved imports are potentially putting desperate patients at real risk of injecting heavily degraded or even contaminated medicine.
Exactly. They argue there is zero visibility into how these gray market shipments are being handled. So it is this incredible, tragic conflict between the crushing, unsustainable cost of U.S. specialty drugs and the very real safety regulations that are meant to protect us from bad medicine.
It's a lose-lose situation. It really highlights the sheer desperation in the healthcare system right now. Employers and patients are resorting to using these sketchy alternative funding schemes because the list prices are just so high they can't afford to breathe.
Yeah.
But the manufacturers are using the courts to ruthlessly shut them down, citing patient safety. It is just another area where the structural system is visibly straining under immense pressure.
That is a very good way to put it.
So, as we wrap up, let's try to synthesize all of this. We have covered a huge amount of ground today. We've talked about AI chips and server farms, massive trade wars and Supreme Court showdowns, the price of eggs and beef, billionaires hoarding gold, and black market asthma drugs from Canada. What is the grand through line here? What connects all these threads?
The absolute through line this week is tension. We are living in a moment where incredibly high aspirations are violently meeting very hard realities.
Elaborate on that.
Well, look at tech. High tech, specifically the AI boom, is meeting the physical limits of power grids, the limits of silicon physics, and the limits of corporate profitability. Investors are no longer satisfied with grand promises. They are violently demanding proof and revenue.
Right, and trade.
Global trade is meeting the hard boundaries of rising nationalism and strict constitutional law. The growing friction between the U.S. and its trading partners and the internal friction between the president and Congress is creating a very jagged, unpredictable landscape for any business trying to operate globally.
And the consumer.
The consumer is stuck in the middle. They are seeing brief flashes of relief in some very specific pockets, like eggs getting cheaper and getting a tiny auto insurance rebate. But they're hitting massive brick walls in others, like record high beef prices and an unaffordable housing market.
It really feels like the easy money, zero interest rate era is officially dead and buried, and we are firmly entering the hard choices era.
I think that is exactly right. It is an era of ruthless calibration. Tech companies are cutting the fat to fund their AI future. Governments are aggressively rewriting the rules of global trade to protect themselves. And individual families are having to be much, much smarter about where they put every single dollar.
Which perfectly brings us to our final thought for the day. We touched on it briefly during this segment on the retirement match proposal.
Yes. The structural shift. If these proposals, like the Trump account and the retirement match, actually go through and become law, we are going to witness a fundamental shift in the American economy.
Because if the government becomes a primary direct investor in the stock market via these matched funds seeding accounts for literally every newborn child, actively matching contributions for tens of millions of gig workers, the federal government effectively becomes the biggest, most aggressive bull on Wall Street.
How does that fundamentally change the relationship between the sovereign state and the S&P 500?
That is the trillion-dollar question. It creates a world where the national economic health of the country is explicitly legally tied to corporate equity performance for everyone, not just the wealthy who already own stock, but every single citizen.
Exactly. Because if the market crashes in that scenario, it is no longer just rich people losing their paper wealth. It is the government's direct investment in the retirement of the working class and the future of the next generation literally evaporating overnight.
Which creates an absolutely massive political incentive for lawmakers and the Fed to just keep the line going up at all costs.
Right. Which could be incredibly good for sustained market growth in the short term, but it could also easily create devastating catastrophic bubbles if the government simply refuses to ever let the markets naturally correct and clear out the bad debt.
It is a huge real-time experiment in state-sponsored capitalism, and we are all part of the test group.
Something very heavy to mull over as you sit down and check your own portfolio this weekend.
Definitely. As always, thank you so much for listening to this deep dive. In a world completely full of mixed signals and endless noise, the details like reading the actual fine print on those new tax accounts matter more than ever.
Stay curious out there, and definitely stay critical of what you hear.
We will see you next time on The Deep Dives.